Are you just starting out with investing? Then this is the video for you, because we are going to cover all the initial steps that you need to take in order to start investing. Everything what you need to know. Hello and welcome. My name is Peter B. and I welcome you here at My First Million, where we are achieving our financial goals together. So, in today's video, we are going to cover exactly what you should be doing if you're just starting out with investing. I am personally a financial enthusiast and have been investing for over 15 years. So I want to make sure that if you're just starting out now, you're not doing the same mistakes that I have been doing. So when you are in a position now to start considering investments, then you need to first know why exactly you need to invest, as investments can make or break your financial success over a long time horizon. For this fundamental understanding, let's take a look at the wealth cycle and we will see why investing is so important. In the wealth cycle, you will see how to win financially. You have your earnings, then you minus all your spendings, and then this will give you the savings. And if you're doing investing, you take your savings, put them into investments, and the investments, of course, hopefully should generate a rate of return. So over time, your investments will be boosting your earnings or even will be replacing your earnings. So many people are starting out in investing. They're already very good at the top line to save money. They maybe have a decent earning, they take good care of their expenses, and they end up with some savings. But savings alone is not enough. Let's say you have $10,000 in your bank account. How much money will you have 10 years from now, 20 years from now, or even 30 or 40 years from now, when you are getting closer and closer to the retirement age? If you just save money, then it will be very close to just those 10,000 US dollars. You will not have much more due to the interest rates nowadays being pretty low. However, if you would invest this money for a very long time horizon, you should expect at least 7 to 9% rate of return over a long time horizon. So with a 7% return, you will roughly double your 10,000 every 10 years if you keep the interest that you're receiving compounding, meaning everything that you receive you will put in and invest in again. You're not taking out any money from the investments that you're taking. So how does this look like? Let's take a look. If you have 10,000 now, as mentioned, in 10 years this 10,000 should double if you let it compound. So you should have 20,000. After another 10 years, so in 20 years, it will double again to 40,000. After 30 years, you should have another double to 80,000. 40 is 160,000 and 50 years is 320,000. So the longer your time horizon is, the more significant the difference is going to be if you're either just saving or you take your savings and put them into your investments. I'm in my mid-30s, so I should have around 30 more years until I reach retirement age. But if you're younger than this, maybe you even have 40 or 50 years ahead of you. So you want to make sure that you can make use of this very long time horizon until you really need this money. So now we understand the importance of investing. Now let's really dive into investments. The first investments that you're doing. And for this, you need to always be aware of rule number 1. Regardless who is telling you something, who is giving you a recommendation, always be aware of rule number 1. And rule number 1 is saying, basically, you need to take full ownership of your investment decisions. Whatever you're doing with your money, it's your responsibility and you need to take ownership of the results. If your investments are not doing well, don't blame other people. but you need to understand fully what you're doing with your money. Also on the flip side, if you don't doing investing because you feel like you don't understand it, you also need to take full ownership that your 10,000 in saving will never grow and always stay at those 10,000. So this sounds pretty scary now because of course you don't want to lose the money that you have so hardly earned. However, with just maybe around one afternoon of research, you will have the very basic and fundamental understanding already in order to get started and be able to participate over this compounding effect over a long time that your money can grow in the markets. It doesn't take a lot. It does only take a few hours to get you set up, started, and maybe a few more hours to study. But this time is probably the best investment of time that you would ever do because over a long time horizon, these few hours will be able to give you a difference of tens of thousands or even hundreds of thousands or sometimes even millions of dollars of difference. So take one afternoon and start studying. And I'm telling you now exactly what you need to study. You need to study how to start investing in an ETF. There are a lot of ETFs out there, but what you want to make sure is that they're low cost. This is extremely important because 1% more or less in cost will make a huge difference, a huge amount in difference. They need to be low cost. They need to be very well diversified. And you need to have a long time horizon. So low cost, well diversified, and a long time horizon. You want to look out for those three factors and you want to study those three factors in the few hours that you're setting aside for this. What does this mean? Low cost. What does it mean? Well diversified. And what does it mean? Long time horizon. Now there are only 4 steps that you need to take until you can start investing. First, you want to open a $0 commission account. So you want to research the market for all the companies, banks and so on out there who are offering trading accounts. And you want to make sure, again, low cost. There are a lot of stock brokers who offer 0 commissions trade. So every time you make a trade, it doesn't cost you anything. So this is not a recommendation now, but for my US investment, I'm using First Trade. And First Trade is one example of a stockbroker who doesn't charge any commission for trades. Then the second step is you want to transfer the money that you want to invest into that account. This probably will take a few days. So therefore I put number 1 and number 2, the first 2 steps, before step 3. So you can do step 3 whilst you're waiting for the money arriving at the account. So step 3 is then research all the ETFs out there. And again, you want to especially look out for very low cost ETF and ETFs that cover the total stock market. The more diversified the ETF is, the less fluctuation you have in your portfolio. And therefore you can track closely the overall stock market. And then the 4th step, once you had done the research and you know which ETF you want to invest in, and you received the money on your account, you can do the first time buy. And maybe you just want to buy 1 share of this ETF first, just to see, can you do the buying process? How does the buying process looks like at your stockbroker? So just do 1 share first to see whether it works before you invest more money into it. So now, as a beginner, you probably will ask, how do I know whether the ETF that I'm looking for is really good or not? I will give you one example here, but again, this is not a recommendation, but this is probably a good start where you can start off your research. This is probably one of the most famous, well-diversified stock market ETF. Its ticker is VTI. So when you want to buy, this ETF, you just need to search for VTI in your stockbroker, and then you will be able to buy shares of VTI. And VTI stands for the Vanguard Total Stock Market ETF. So Vanguard is one of the companies that is providing ETF, that is offering ETF for us. So Vanguard is then buying all the individual stocks in the ETF and diversify the money for us. But of course there are other companies out there who offer very similar service. Like for instance, iShares is another brand of ETFs that you will find out there, and there are several others. Again, as a beginner, you want to make sure that it's very well diversified, that there are more companies covered in the ETF. And if I'm not mistaken, I believe Vanguard Total Stock Market ETF is investing into more than 3,000 companies around the globe. So whenever you are investing into an ETF, you want to make sure that you will check the expense ratio. When I started to invest into ETFs, a low-cost ETF's annual expense was around 0.2%, which was significantly cheaper like other mutual funds. However, you can see nowadays it's even much cheaper than that. You might only need to pay 0.03% of annual fee. So of the total amount that you have invested every year, you got 0.03% deducted. So this is basically the earnings that Vanguard will take from you in order to provide you the service that they will diversify your money into those different companies. And that's really very cheap. So if you are expecting maybe 7% return, 0.03 is very diminishing. However, if this expense ratio would be 1 or 2%, this is a huge chunk of your 7% rate of return, expected rate of return. Then another thing you need to take into consideration is a risk-reward scale. So now you might ask yourself, why is the risk at the 4 or 5 maximum points? It's because it's all invested in the stock market. It's not at the 5, because maybe if you would just pick one company from the stock market, it would be even higher risk, because then it also depends on how good this company is doing. But the VTI is basically covering the whole stock market. So we have a little bit of a reduced risks, but when you take a look, for instance, at the S&P charts of the stock market charts, or at the Dow Jones Industrial Average, you will see that the pricing in the stock market is fluctuating a lot. Sometimes it's go up and sometimes it's crashing down again. So it's pretty common that you will see a decrease of stock prices of 20% on a short notice. And every once in a while, you probably also need to expect that the stock market is crashing maybe 50% or so. So this sounds very tricky. However, the key there is having a long time horizon for your investments, giving your investments time to grow. As said, maybe the average is around 7 to 9%. If you have a long time horizon, you could expect around 7 to 9% rate of return. However, if your time horizon is maybe only 10 years or even shorter, maybe 1 or 2 years, maybe you just pick those times that the stock market is underperforming. It could happen that within 10 years the stock market is not doing a lot. You invest your money now, maybe it's going up, maybe it's going down, and in the end after 10 years maybe it's more or less at the same level where you have invested at the beginning. And we have seen this between, I think, the 2001 to 2010 area, where 10 years the stock market wasn't really having a positive return. In a shorter time horizon, like a 1 year or 2 years, this effect can be even more extreme. So for instance, if you have started investing in November 2021, you would have picked a very bad timing to start investing into the stock market. because over the next year or so, the stock market was going down gradually and it was getting worse and worse. So the ideal solution, but you might now think, oh, okay, I will just try to time the market. However, market timing hardly ever works. Even professionals usually cannot really properly time the market. And if you are watching this video, I guess you're a beginner, so you probably even have less experience and less advantage to really properly time the market. So instead of timing the market, you just want to even out your investments over a long time horizon and continue investing over and over and over again. So at least that over time you will get the average price of the stock market, which is good enough for you to get a 7 to 9% rate of return. So how will you get this average return? It's just continue to invest every month. Let's say you can save $1,000 every month. Then just invest this $1,000 every month over and over and over. Sometimes when the market is shooting up, maybe you pay a little bit too high of a price. Sometimes when the market is crashing down, you will get huge bargains and can buy more shares cheaply. But if you always invest the $1,000 over time, you will very likely do better than someone who is trying the market. And this is exactly what you want to do. You want to have a system and take the emotions out of your investment decisions, especially as a beginner, but even professionals also need to do that. Don't try to time the market, just have a fixed plan. Every month, one specific amount invested into the stock market will give you a very decent return over a long time horizon. So this is basically all what you need to know in order to start investing. Of course, as I mentioned in the video, maybe you want to sit down, take an afternoon off and really research those topics that I have covered in this video, so that you by yourself have a full understanding on what you're doing. Because never forget rule number 1. In the end, you need to understand what you need to do and you need to take ownership of your investment decisions. Once you have established this, of course there are other investment opportunities out there. You could invest into single stocks, you could invest into real estate and many other things. However, all the other things outside of what I have shown in this video will require you to spend a lot of time in researching, time in learning, time in understanding the market, and so on. So only if you have the passion for it, if you have the interest for it, and if you can set this aside this time for having this hobby, you should then explore other investment opportunities. But if you don't have the time, or if you don't have the passion for it, just stick with your ETF plan and you will succeed financially over time. Where are you in your investment journey? Please share with us in the comments below and maybe we can help each other out to take the next steps. Thanks a lot for joining me today. I look forward to seeing you in the next video, and especially I look forward to seeing you winning financially.